No more swearing.
Yeah, okay,
But
well,
anyway,
I have to,
uh, all right, let's retweet
Hey,
it.
whatever.
Jen,
You guys
Jen, this
are
has to,
live.
Jen, this has to be typical show business for you.
It is,
All right.
sure. But it doesn't matter because now he's in the don't
Uh,
retweet it, Ben.
don't? Okay. All right.
So are
Anyway,
we going
so
live
yeah,
yet?
what
Let us know.
Paul, did you see the tweet I put from Jan LeCun, the guy who's head of AI for Facebook, who had
No, I
come
didn't
out and
see that.
said, "Hey, we're starting to see a logarithmic plateauing of the input-output ratio for these models."
Mm-hmm.
Like you wonder if, he's an authority, obviously, and he's been pretty pro. There's some guys like Gary Marcus who have been kind of negative. So
Yeah.
you take that with a grain. It's like the equivalent of a doomer. That's all he's telling you. Hey, economy's going to fall, whatever. But
Yeah.
it's worth taking a look at. I'd be interested in your thoughts. Because, the one thing I had a thought about with this is there's so many people. So I had read that Elliott just named their first woman partner ever. And she had started in 2013. And I had this idea that was like, man, there's so many people on Wall Street who have never seen a true CapEx cycle. Because I think the real last CapEx cycle we saw, as Bob will attest to, was the shale CapEx cycle. And that was a monster. And but like 2015 to 2021, even early 22, there was no real CapEx cycles at all. And CapEx cycles, as all you guys know, you've been around longer than me, is a cyclical thing. So there is the other side to this, and I just wonder like how many guys in the street like fully understand like CapEx cycles. I mean,
Yeah, good point.
what are your thoughts there?
Well, I mean, the way I look at it, you never want to say this time is different, then it's more of the same old, same old. But the CapEx, being spent by the hyperscalers, and every time they reach out to us, they confirm this CapEx number. They typically raise this CapEx number. If it was spending by companies that didn't have such strong balance sheets, then I'd start to be a little bit worried, right? Because they could
That's
they
right.
could always back off at any time. So Meta is an important data point, but Meta also, essentially has an open large language model, right? Instead of depending on some of the other guys like an OpenAI or Anthropic. So that's clearly a negative data point. But I still think that 25 is going to be a continuation of 24 with the large language model spend. And in the meantime, it's being concentrated by guys that have, sterling reputations, typically good on their promises, and typically say they're going to spend X on CapEx and even spend more than that at the end of the day. So I'm pretty comfortable with those guys. Now, if Meta pulls the plug, they're one of the hyperscalers, but they have a little bit of a different, with their open models, a little bit of a different tilt to this thing.
But what you think that like the stocks are trading off 26 by this point? Like I think like with the CapEx plans from these guys, like kind of in the bag, and those are forward-looking things that really the stock's going to be like, what's the rate of change on 26 versus 25 at this
Yeah.
point?
Yeah. Well, we'll get a look see at Nvidia on November 21st, and today's November
Yeah.
13th.
So that's probably the last really big market event. I mean, I guess the Fed, but whatever. I don't think that's a big deal. I mean, even if they pause, I don't think it's a big deal. I think Nvidia is probably the last bogey after this morning's CPI came in kind of in line. Got a little bond rally today, Charlie.
Yeah, I saw that. Was that because CPI wasn't too bad?
Yeah. I mean, it was essentially
in line.
line, right?
Yeah, 0.3.
Yeah.
I will say, this 448, 450 area has got a little bit of resistance. We'll see if it's been bumping up against that. I wouldn't be surprised if we have a little bit of a rally in the bonds going into the end of the year. But I still think we're going to be at 5% next year at some point.
One thing I would note though is since the Fed meeting, when we came on the show, Charlie, me and you, and said it was time to sell bonds, the long end of the curve has flattened actually. which is not conducive or, it doesn't, it's not what you'd see if we're in the beginning of a new cycle. Let's put it that way. You know what I mean? Like the 1030 is basically trades opposite of how the DXY trades, the dollar. And that's coming in. And then also the 210, which is kind of the most cited, yield curve spread, is damn near inverted again, like 4 basis points.
I still think the bear steepener is going to play out in 25, and I've been buying IVOL in anticipation of that, and it's down, in an attractive buy zone now.
Yeah, I think the Fed has to be, if they want to do this, they got to cut in a nonlinear manner, and so I don't know, maybe this tariff threat dollar ripper will give them that opportunity at some point, but it's kind of weird that they're cutting and we're at all-time highs. I will tell you that.
Yeah, and Scott Bessent wrote, an opinion piece in the Journal the other day, where he acknowledged that they have to term out the debt, and it's going to be, require some deft maneuvering. But as you know, they've got some things in their back pocket. The TGA account is 800 billion, so they can run that down. They've got, the SLR ratio can be changed to allow banks to buy more. They can take the asset cap off Wells Fargo so they can come in and start buying treasuries. So there are levers they're going to pull to try and, keep that long end under control.
I thought it was interesting that, Bessent, even though I don't think it's been formally announced, will be the Treasury Secretary when all during the campaign it looked like it was going to be John Paulson.
Yeah.
It's a interesting pick, and that in and itself is something.
I thought that Lighthizer, Jake Clayton both had their hats in the ring, I think. Other guy?
Howard Lutnick is the other. It's Scott Bessent and Howard Lutnick is, I think, the two shortlist candidates. I hope it's Bessent. I think he has a little more.
And Bessent's here in Charleston, and he used to work for Soros.
Yeah. I dealt with him when he was at Soros.
Yeah, that's kind of interesting.
All right, looks like the clock has hit 0. All right, welcome to Wall Street Beats. My name is Benjamin Bry. It's November 13th, 2024. Today I'm joined with Paul Meeks, Charlie Peabody, and our oil man, Bob Morris. So let's start with Paul. He's going to talk about some tech stuff. What do you got?
Yeah, so I've been talking about Tesla for some time. I attended that We Robot event where they were splashing the new vehicles and also the robots down in Hollywood. And, the company has come off, which I thought was a pretty weak quarter. Maybe it was a catalyst to the upside just because expectations were so low, but fundamentally, a company that's still probably in some peril. But I've been holding off, right? Because I knew that you're going to have this bromance between Musk and Trump. And when Trump won, which I thought he would, then you would have a skyrocketing in the shares. However, the reason I'm bringing it up today is I've been watching it carefully, Ben. And even though the stock's up today on a little bit of a rebound, it took its first hickey yesterday since the election. And I'm kind of wondering, because I've moved from a fundamental bear thesis to kind of time and pace to trade based on the technicals, that I'm wondering if yesterday's actually finally giving up the ghost a little bit is showing me a sign that this euphoria is starting to wear off, right? Trump is already named, Viswaswamy and Musk as the leaders of this new Department of Energy Efficiency. And so that news is out, no surprise. Anyway, I'm watching the technicals because I think the halo effect at some point has got to taper a bit. And now that all the news is out,
it's off $30.
Pardon me?
It's off $30 since the Q4 high. Hit 360. Now we're at 330. So it does kind of look like a little bit of a shooting star, if you will.
Yeah. Well, particularly since the news is now out confirming that this not fictitious, but this whatever you want to call it, Department of Government Efficiency is a thing, and Elon Musk is a thing and a part of it. I think, Ben, the other day you cracked me up. I think it was you that said, well, now that Elon Musk is the de facto president of the United States, could be true. So I've been looking at that, and yeah, I want to see what happens over the next couple of days. But the stock finally took a tumble despite all the euphoria. That's usually like the buying has been exhausted signal. At least I hope. The other day, Mackey appeared. I was not on the show, but of course I read everybody's notes, and I concur with him on the bull thesis on Amazon. Because I'm in the media a lot and I cover tech, I always get asked about the Mag 7. And, I'm starting to, wane a little bit. I still am a big fan of NVIDIA, of course. They're going to report in about a week's time. But, some of these other stocks have started to roll over. And I don't think it's just because, you're having what they love to say in the media, a broadening of the market. The small caps are finally having their day. Stocks like Microsoft are rolling over regardless. So my focus on those large cap tech stocks that I'm always asked about is starting to be more focused. And I do think Amazon is unique in that regard. So I concur with Mackey's bullish thesis. Next thing I wanted to mention is it's a German company that not too many people follow, but Infineon, the semiconductor company, is actually the leader in chips for automobiles. And they had a really poor quarter. I mean, there's a real bifurcation of if you play the semiconductor group at all, and maybe some of the bloom is coming off that rose. But, these IoT companies, remember Internet of Things a couple of years ago was like going to take over the world. And then, of course, the automobile sector. Yeah, we're going to have all kinds of chips on our dashboards. Boy, when you see Infineon, which is very heavily wed to the auto sector, reporting its dreadful results and guidance, that tells you that part of semiconductors really is in trouble. And so be careful of all the U.S. companies that are in that wake. These are companies like Analog Devices, Texas Instruments to a certain extent, Marvell, Microchip. These are your kind of industrial semi companies. Looks pretty scary. And then the last thing I want to say, which I think is a bullish sign for tech, is the Swedish fintech company Klarna announced its IPO today. And I think this is going to, at long last, because the IP window has been closed, Ben, this is going to be very positive. I don't even think Klarna's that great of a shakes, but it has been out there for a long time. Finally seeing the appetite for an IPO. Ben, you and I know a little bit about a company here in the States called CoreWeave. Now, CoreWeave I'm investing in pre-IPO. I think CoreWeave, which is a cloud data center for AI, very close partnership with NVIDIA, is going to be a really big IPO now that the window is open. And I think that comes as soon as Q1. So that will bring some excitement as well. So I like the fact that, this is a positive sign that they're able to do deals again. And I think in the pre-show, Charlie, you were talking about capital markets.
Well, yeah, absolutely.
Do
you know who's leading the Klarna IPO?
I think they've already, CoreWeave has already hired Goldman and Morgan Stanley, and JP Morgan might be in the mix too.
Okay.
Yeah, if it's a big IPO, those are the three, regular guys that would be on it. I mean, it will be big. We've seen the window open. I talked about that KinderCare, and that there have been a couple deals. My email box, I have a million emails from all the different banks, and I'm starting to see the deal flyers coming in more and more. Some secondaries, so a few IPOs. Look, the capital markets, equity capital markets have been absolutely dead for going on almost 3 years now. So it's probably needed.
It's put a lot of pressure on some of these, VC funds and other, private equity funds that have been chomping at the bit to, get liquid, right, to exit. They
need to return capital to their limited partners. I mean, and they haven't been able to, as you said, because they haven't been able to monetize their assets.
Yeah.
That's kind of what some individual stock stuff and then some broader stuff. I think this IPO window is significant for my sector.
Yeah.
Okay. That's a nice way to let's segue into Charlie and talk about banks more specifically and what you're seeing and what you're expecting for the go forward. Now have the election in our rear view mirror.
Absolutely. And I just want to reiterate what Paul said about maybe there's a short-term, top in euphoria around the Trump trade, because I did see the banks, show some weakness yesterday as well. And they are very much a big part of the Trump trade. But, so we may have some, backing and filling here into December, but I'm a buyer. I think there'll be dip buyers all along the way, because I think there's still another run to the upside. And so that's what I wanted to talk about. Right after the election, I provided a conceptual framework of how banks would benefit from the Trump election. And I cited 5 things: tax cuts, regulatory relief on capital, improved capital markets activity, growth policies that could spur loan growth and improve net interest margins, and then revaluation, a multiple revaluation due to a lighter regulatory touch. And then I think the last one was increased, return of capital through buybacks and dividend increases. So the bottom line of back then was this could add 20 to 25% upside from the pre-election prices. So today, Jen, I don't know if you can put up the table. I've tried to quantify those variables in a report that I published on Sunday. And the bottom line is, on the tax cut front, obviously we won't know that until we get into January, what Trump is going to pursue, but he's proposed a cut in the corporate tax rate from 21 to 15%. And that would add about 6 to 8% on average to bank earnings, because banks do pay a full tax rate of anywhere from 20 to 26%. So that's a big increase in their earnings power. In terms of buybacks, banks are already fairly active in buybacks. Some are doing 5-6% share buybacks, like Wells Fargo and Citizens Financial, CFG and WFC. But on average, we think that they could add another maybe 1 to 2% to their earnings from additional buybacks, because the Basel III regulatory capital rules are either going to be completely rolled back to nothing, or they're going to be postponed until 26, 27. So all the capital that these banks have been building up in anticipation of Basel III being implemented are now going to redeploy that capital. I think buybacks will be episodic because these banks' stocks are starting to get expensive, but certainly we're going to get pretty aggressive dividend increases of high single digits, low double digits early next year once the tax cuts are imposed. So this is the matrix that I published on Sunday night. The third thing would be capital markets activity. We think that there's going to be a real push on the M&A side, particularly large deals, because the large deals were the ones that were succumbed to the antitrust attitudes of the Biden administration. And with large deals, you get bigger fees. So there's probably, and then as we were just discussing with Paul and Ben, IPO activity is clearly going to be picking up. And there's probably 50% upside in the revenues of these large institutions from M&A and IPO activity if we get back to the levels we saw in 21, 22. So that's going to add, on average about 2 or 3% to earnings. But then, you've got the outliers like Goldman Sachs that could have an 8% increase in their earnings if we get back to those 22 levels. So, and that's probably the one area that's going to be priced in right away, because it doesn't require any sort of legislation. We just know that, with the election over with, companies are going to start moving forward and anticipating, a stronger capital markets activity. So I would say that the Morgan Stanleys, the Goldman Sachs, the JP Morgans are going to get more upside right away. And then even some secondary regional names like Citizens Financial, which had been buying a lot of capital markets shops during 20 to 23, probably have benefited from that activity. The fourth thing, which is a little harder to quantify, is the growth policies of the Trump administration are likely to spur greater loan demand, and we estimate for each 1% increase in loan demand, you get slightly less than a 1% increase in earnings, and then it'll probably spur a steeper yield curve, and that's beneficial to net interest margins. And we estimate that for each 5 basis point improvement in margins, you're going to get about a 3% increase in earnings. And then the last thing, and this is really revolves around revaluation of bank stocks. Bank stocks typically peaked out at 55% relative to the market multiple. So they were trading 11.5, maybe even 12 times on good days recently. But if we get less regulation, we're going to have less expense, inflation from regulatory issues, and we're going to have less headline risk, such as consent orders being announced unpredicted. And so that leads to likely revaluation of these stocks to a higher relative multiple, so maybe 60%, 65% of the market multiple. Each 5 percentage points of improved relative valuation is about a multiple to multiple and a half added to their 11.5, 12 multiple earlier. And so that's about 9% upside there. So the bottom line, if you add all those things up on that chart, I don't know, Jen, if you can put it back up again, but the bottom line of all of that chart is we see about 20 to 25% upside. We've had, probably about 13 or 14% upside so far. So there's probably another 10% of upside in these stocks. And so if we get a pullback going into December, I would buy that, as I think these things are going to rally right into the first 100 days of the Trump administration, when they start to push all their policies through Congress.
So Charlie, what would be your from your list for your thesis? What would be your picks here among that?
So Citigroup is my number one pick. It was coming into this, although I was sort of laying off it going into the election. But there's probably another 14% upside in Citigroup. If you want the creme de la creme, JP Morgan is the go-to name, probably well owned already, but there's probably 15% upside there. If you want a lesser known regional bank, Citizens Financial is certainly a beneficiary of the capital markets. The ones that actually sort of have less upside in my mind, because they've already had a pretty good run, one would be Wells Fargo, which has been one of my top picks. So I'm not saying you shouldn't buy it if you get some pullbacks, but based on my valuation framework and structure, I think there's only about mid-single digit upside. PNC, and Bank of America don't have as much upside as well. The one thing I also want to emphasize right now, the marketplace is emphasizing the P&L statement. That's what they're focused on. And the reason they don't care about the balance sheet is because they truly believe in a soft or no landing. So they see the balance sheet risks as non-existent. For banks, if you ignore the balance sheet, you do so at your own peril. And I do worry about some aspects of the balance sheet going into next year, but as long as people are not worried about, reduced growth, then they're going to ignore the balance sheet risks. And one of the obvious balance sheet risks is what's happening to the value of the assets as rates rise. And, we pretty much have gone back to the kind of unrealized losses in these bond portfolios that existed in July, before we had that big rally in August, September. But right now they're ignoring those unrealized losses.
So I mean, it has re-rated a lot, right? Is there, just like Goldman's up 16%? We into the election, the algo had said, oh, buy these MTB and Goldman and all these. Is there a risk of chasing it here? Tesla, banks. I mean, Bitcoin's at 90K. It seems a little bit like you got to wait if you're going to try and get involved, don't you think?
Yeah, I'm following up and agreeing with Paul. I think we saw some short-term action that says there's going to be some backing and filling going into December. So I'm not going to chase them here. mean, my discipline on someone like Goldman is that there's probably another 9% upside from yesterday's closing price. So, that's a 640, 645 type of target price. But, you're not going to sit around for the last 5%. So, yeah, I would like to see some, backing and filling before I chase these things again.
One final question: where's the risk? Where's the risk for banks? If you're like, okay, what's the hidden risk that could hurt these guys? Would be rates higher?
Yeah, I mean, I've been sort of using that area of 470 to 5%, as where I think the balance sheet will matter. And the real question is, what happens to the deposit structure going into year end or the new year? And do we see some liquidity outflows from the banking system's deposit structure into money markets and chasing the higher yields? If we get deposit outflows, that's when people will start to worry about those unrealized losses, because that's what set off the Silicon Valley situation. But so far, the deposit base is stable. The unrealized losses have moved up, 60 or 80 basis points, but the markets haven't been moved by that. But I do, if you look at where this whole equity rally started in April, May, it was when the 10-year yield was around 470, and it came down to as low as 435 or somewhere around there. So I think if we start breaking through that 470 on the upside, that's going to raise some concerns again.
All right. Well, that's be good to be interesting. I'm excited about capital markets coming back. Let's talk about oil, Bob. $67 oil. What do you got?
So I just want to follow up on EOG Resources, which has had a nice pop in the last 2 days, post their earnings on Friday. On Friday we came on and we were talking about Diamondback, which up to that point had been our favorite name coming out of earnings over that prior week. We hadn't yet then gotten EOG's results, and they were very positive. EOG's my second largest holding in the energy space, but there are 4 important points here coming out of the quarter. One, they beat on production and they beat on operating cost guidance, and as a result, they raised their full year production guidance. They lowered their full year per unit operating cost guidance. So that was positive overall. 2, they said for 2025, even though they haven't given specific guidance for 25, they said their activity level is essentially going to match this year. So again, not a positive for the oil field service companies, in that these companies are not adding rigs, they're not ramping up activity. Despite some of the rhetoric out of the Trump administration, these companies are not looking to, increase drilling activity going forward here at this point. The third point was they raised their dividend. So their base dividend was upped by 7%. And at the current stock level, the yield is 3%, which is very nice in this sector for a 3% yield. The fourth point, which is the most important, and really this is what underpinned the pop in the stock and is unprecedented in this sector, is that they said, quote, they're going to shift some equity to the debt side near term. What this means is they think their optimum debt level should be higher than where it is currently. And I agree. This is something that when I was on the sell side, I used to always push the company about, that they weren't running an optimum debt level, that it was too low. And as a result, they said, look, near term being over the next 12 to 18 months, they're likely to bump up debt levels by up to $2 billion. What does that mean? That means they're going to be returning 100% and sometimes more than 100% of their free cash flow to shareholders. And that's significant. And I think that that return to shareholders is going to be primarily in share buybacks. Over the past 4 quarters, the excess free cash flow, which has been 85% of their excess free cash flow has gone back to shareholders, has been as share buybacks. They haven't paid a special dividend since over a year ago. So I think at current stock price levels going forward, that juiced return to shareholders is going to be primarily in the form of share buybacks. And again, that's going to be significant. It's unprecedented for this sector, for companies to say, look, we're not continuing to pay down debt. In fact, we think we're going to bump up debt a little bit. We're going to give all the money back to shareholders. So this, what I call the over-the-top return to shareholders, is unprecedented. I think it's significant. It's a positive for EOG. We still like the name here. I'm bumping my price target to $150 a share. Obviously, as you pointed out in the pre-show, Ben, oil's down today. Stock's outperforming today, but it's off just about 0.5%. But I'm a buyer on any weakness if you don't own the stock. Again, it's my second largest holding, so I've got a pretty good position here, but still like this name.
Hey,
Yeah,
Bob,
go
the
ahead,
number
Paul.
one holding is CNQ.
Yep, C&Q is still my largest holding. There's some dollar issues with the dollar being strong here, given it's a Canadian company. They sell their oil in dollars, but all their operating costs are in Canadian dollars. But yeah, that's got a higher yield dividend-wise than does EOG right here.
EOG has always been like the most conservative of all the E&P companies. And so it is kind of an interesting thing to point out to people that they're going to take on some balance sheet risk. And look, this stock's barely off from the 22 levels, oil's down 50% or 40%. This thing's at 132. It was at 150, I think, at the peak. So to their credit, not having a lot of balance sheet risk, they hung in there. But this is kind of an interesting idea. I've always thought of this as like the highest quality E&P you can own. So, and maybe just to cap off what we kind of talked about with all three guys now, is the capital markets. And if we're going to have a little deregulation, how could that impact the oil guys? Because, they've kind of had a rough run of it with capital flowing to them.
Right. And you know what all these companies have done is they pay down debt because they were afraid that they weren't going to be able to borrow money. And the banks were under pressure to not lend to the energy sector under the prior administration or what is still the current administration. And so a lot of them were afraid of that. And they thought, well, if we can't tap the debt market and we're not going to tap the equity market, we should make sure our balance sheets are pristine. And they've used some of that excess cash to pay down debt. Now going forward under the new administration, I think those concerns are going to ease a little bit here. But I do not think that's going to prompt these guys to go out and drill more. I don't think it's going to prompt across the board action like we saw at EOG, where everybody says, okay, let's bump up debt a little bit here. I think EOG is unique in that regard. But I think the capital markets will be a little bit more relaxed if they do need to borrow. And that's probably going to come in more in play in M&A. We've seen some deals here where companies have taken on a little bit of debt just in complete M&A transactions, which may be a little bit easier here if the banks are more friendly or less regulated in that regard.
Is there any risk that maybe some newer guys, like, hey, capital starts to flow, and the public guys have kind of found Jesus, if you will, and aren't as crazy on drilling as they used to be, but maybe some other guys come onto the scene and leasing?
Absolutely. I think that's a positive for the private sector. And I know there's been a lot of private money that was capped in what they could lend or invest in the energy sector. And they were trying to do things, outside of funds because they were tapped out because of all, what were the issues for lending or giving money to energy. They were tapped out in their funds and putting private equity into energy deals. And so this may loosen up a little bit, particularly with regard to Trump's mantra of drill, baby, drill. I don't think the public companies are going to go out and break from their discipline. So what that means, if there is more incentive to drill and there are more leases made available, that's likely to go to the private side. And they're going to need funding for that. And so I think there's going to be a better environment for private equity to invest in energy going forward in some of these private companies or startups.
Yeah. So it's an interesting time for oil because there's no one talking about oil. It's $67 and it just like couldn't be farther out of favor, I guess, right now. But yeah, all right. Well, thanks. That's great. EOG, tech, capital markets, and the banks are back, baby.
Ben, I wanted to ask Bob one question about the geopolitical risk premium in oil, and most people I think believe it's not in there anymore, but some of the technical traders I talk to on oil think there's still a risk, not necessarily a possibility, but a risk that it spikes down to 62 or something like that. And I'm trying to think of what would cause that. And I was just sort of thinking out loud, let's say the new administration is capable of ending the war in Ukraine, or reducing the geopolitical risk. Is there another spike down in oil prices in your mind, or do you think we bottomed?
I mean, there's potential for a little bit more weakness. I don't see a spike down. It's just interesting you say 62 because I was going to say I think the geopolitical premiums come into around $5 a barrel here in the oil price. There's a little bit still in there. And some of that's come out because of the view that Trump's going to end wars. You know, he came out and that's what he said. He said, I don't start wars, I end wars. And he's already had, you know, some phone calls that he's going to try and tap down tensions in the Middle East and what Israel's trying to accomplish. He's going to try and broker a peace deal between Russia and Ukraine. And the thing that, you know, makes some people nervous is that Trump, the biggest thing he can do to tap down inflation is reduce energy costs.
Sure.
And how's he going to do that? You know, he came out and he said, drill, baby, drill. Like I said, you're not going to get all these public companies to break from their discipline and all of a sudden ramp up and start spending like banshees like they did for 30 years up until 5 years ago, which got them into trouble with investors. They see that investors are rewarding them for being disciplined and returning excess cash to shareholders. So what strings does he pull to bring down energy prices? I don't know, but does he put pressure on Saudi Arabia or OPEC? Remember, OPEC sitting on, you know, there's 4 to 5 million barrels a day sitting on the sidelines, being restrained by OPEC to try and prop up oil prices. So what sort of levers or strings does Trump pull to try to bring down energy costs? He obviously wants to boost production in the U.S., but that's going to be tough. Again, these public companies there's not anything I think you can do to make them want to go out and all of a sudden break their discipline and spend and a lot more than they have been. So that's the one concern. What does he do to bring down energy prices? Because that's one of the biggest levers he has to bring down inflation, is to bring down energy costs.
And so where are we in terms of replenishing the strategic petroleum reserves? Is that still to be done?
That still needs to be done. Yes, that still needs to be done. It was drawn. We've been filling it a little bit here over the last several months, but the current administration drew it down heavily during times for political reasons, wanting to bring down energy prices.
I had heard a guy argue to me that the SPR didn't need to be as high as it was because now that we're oil exporters and, you know, like if you go back to 08 when we were doing 6 million barrels a day, 7 million barrels a day, now we're doing 13 plus, that if you do the SPR divided by imports and kind of normalize it, it's not as crazy, like depleted as people do if you just look at the chart. What do you think about that?
I mean, there's truth to that. I mean, we're a net exporter of crude oil now, but it does flow to our allies too. I mean, Europe and other places are not exporters. So if we need to export more in a crisis situation to our allies, you know, you need to draw on that oil, and you know, hopefully there's no major disruption in the U.S. But you're right, we don't need as much as we used to, but we need to have it. We need to have it there.
Is there a chance Trump can go to Saudi Arabia and cut a deal with them? Maybe that's the direct way that he could get something done. But I mean, they're probably not incentivized to have oil go back to 50, are they?
No, they're not. But I mean, that if you said, look, you can do anything you want to do to bring down inflation, to bring down energy costs, that would be the easiest thing to do. But I think OPEC, given that they continue to extend putting some of the production cuts back in the market that they originally were going to do beginning October 1, and they've continued to push out putting that oil back in the market, tells you that they want to keep oil prices here in this 60 to 70, probably closer to $70 a barrel. So they'd have to have some pretty strong army to get them to sort of pull back from that.
So you view the energy space kind of asymmetric, like there's not too much downside from here. Is that the way to think about it?
I don't think there's significant downside. Like I said, I don't think there's a spike down, but the harder argument to make is the bull argument. What is the upside? Yeah. What is the spike in oil prices? The only argument for a sharp spike in oil prices is some geopolitical event in the Middle East or somewhere around the world. Otherwise, we're not going to see a sudden tightening in supply demand. China's all of a sudden not going to start to grow off the charts. So it's harder to make a bull argument than a bear market.
You're also entering the prime period for tax loss selling. I think it's like between November 15th and early December is the prime tax loss selling period. So that could cause some additional weakness. But I'm with Bob. I like these names here.
Yeah, and it's interesting, Charlie. There are certain names. EOG is not one of those names. They're up nearly 10% on the year. You know, seeing Q's up, Diamondback, I think maybe flattish at this point. But yeah, some of the poorer names like the Devons, the Apaches, yeah, there could be tax loss selling in those.
And what about one last thing on this? What about the, you come out and you see the woman who's the head of the or not ECB, but EU and Brussels say, hey, maybe we'll buy some more LNG from the US, like just front run that right after the election. Is this good for the MLPs and the nat gas guys? What do you think about that part of the equation?
It's absolutely positive, and that's the bull case for natural gas. Ultimately, we've talked about that before. As you get further into the latter part of 2005, you've got an uptick in LNG export capacity. You've got the AI data center demand. You've got a lot of bullish factors for natural gas looking further out. Near term, you still got the winter ahead of you, and it's been very warm here. And you still got a lot of these E&Ps still sitting on shut-in production or DUCs that they haven't completed. Williams companies came out last week, which they're one of the biggest pipeline infrastructure companies in the U.S., said there's about 4 BCF per day behind pipe that's not flowing because companies are holding it back given the low natural gas price environment. And that's on a base of 101 BCF a day. So there's nearly 4% we could increase natural gas production in the U.S. just by turning some valves or turning on some wells. So, near term, it's a little bit loose, and that's why we've been a little bit cautious to get aggressive on the gas names. But long term, yeah, it's bullish. There are a lot of bullish factors for natural gas long term.
Yeah, and we have like 12 BCF of trains coming online in the next 18 months, right?
12 to 13 BCF a day. Yeah, it's a lot.
Yeah. Well, okay, that's it for today. Thank you, guys. It's been a good show. Capital markets are coming back is the one thing we had as a common theme here, which is exciting. So come join us tomorrow, and we'll see you later.
Thanks, Ben.
Thanks, guys.
Thank you very much.
Thanks, Jen.